You sold some stock this year. Maybe you sold some crypto, maybe you sold some rental property, or even your primary home. Congratulations. But now comes the part nobody loves, figuring out what you owe the IRS. Investment taxes are one of the most misunderstood areas of the US tax code, and getting them wrong can cost you thousands. Let's break them down all clearly. Welcome to taxamerica.co, your tax expert for the 2025 season. I'm Cedric, and today's video is your complete guide to investment taxation. We're covering short-term versus long-term capital gain rates, how to calculate your gain or loss, tax loss harvesting in depth, mutual funds and ETF tax quirks, crypto and digital asset taxation, real estate, capital gains and the home sale exclusion, and the net investment income tax. Let's get into it now. What is capital gain? A capital gain occurs when you sell a capital asset, stocks, bonds, real estate, crypto collectibles, for more than what you paid for it. Your cost basis is what you originally paid, including commissions and fees. Your proceeds are what you received from the sale. Gain equals proceeds minus basis. It sounds simple, and it is conceptually, but the details around basis calculation, especially for assets acquired over time, can get complex quickly. Short-term versus long-term, biggest decision. This is the most critical distinction in investment taxation. Assets held for 1 year or less generate short-term capital gains, taxed at ordinary income rate, up to 37%. Assets held for more than 1 year generate up to 37%. Assets held more than 1 year generate long-term capital gains, taxed at preferential rates of 0% to 15% or even 20%. For 2024, the long-term capital gain brackets are 0% for single filers with taxable income up to $47,025 and married filing jointly $94,050, 15% income up to $518,900 single and $583,750 joint, 20% above those thresholds. Example, you sell stock with $50,000 gain. If you held it for 11 months, short term, you're in the 24% bracket. You owe $12,000 in federal tax. If you waited just for one more month, long term, you owe $7,500 at 15%. That 1 month of patience saves $4,500. This is the power of holding period. Calculating your cost basis. Your basis is what you paid for an investment. For stocks purchased in single transaction, it's simple price times shares plus commissions. For stocks purchased in multiple transactions at different prices, common with regular investing, you have several accounting methods to choose from. FIFO, first in, first out, is the IRS default. Assumes you sell the oldest shares first. Specific identification lets you choose exactly or which shares you're selling. Powerful for tax planning. Average cost is available for mutual funds. The method you choose affects your gain or loss significantly. Consult your brokerage and your tax advisor before selling. Inherited assets. Step up in basis. When you inherit assets, you receive a stepped up basis equal to the fair market value at the date of death, regardless of what your original owner paid. This is one of the most powerful wealth transfer provisions in the tax code. If your grandparents bought stock for $5,000 that is worth $200,000 at death, you inherit it with $200,000 basis. If you sell it immediately for $200,000, your capital gain is zero. This effectively wipes out a lifetime of unrealized gains. Keep records of the date of death values all the inherited assets. How it works. Tax loss harvesting is a deliberate strategy of selling investments at a loss to offset capital gains elsewhere in your portfolio, reducing your taxable gain at your tax bill. Capital losses first offset capital gains of the same type. Short-term losses against short-term gains. Long-term losses against long-term gains. Then net short-term and long-term results that they combine up to $3,000 of net capital losses can be offset ordinary income annually. Losses beyond 3,000 can carry forward indefinitely. The wash sale rule, critical. The wash sale rule prohibits claiming a loss if you buy the same or sustainable identical security within 30 days before or after the sale. The 30-day window applies on both sides, so you need to wait 30 days before and 30 days after to be safe. If you violate the wash sale rule, the disallowed loss is added at the basis of the replacement security, delaying rather than eliminating the loss. Crypto currently is not subject to wash sale rules, though legislation to change this has been proposed. Pro tip: a common tax loss harvesting move. Sell a losing S&P 50 index fund, say Vanguard VOO, and immediately buy a similar but non-identical one, iShares IVV. You maintain your market exposure, harvest to loss, and avoid the wash sale rule because these are different securities tracking at the same index. When to harvest and when not to. Tax loss harvesting makes sense when you have significantly realized capital gains on offset. You're in the 15% or higher long-term gains bracket, so the savings are meaningful and the investment you're selling has genuinely declined and you want to reinvest in something similar. It doesn't make sense when you're in the 0% long-term gains bracket, nothing to offset. The transaction costs exceed transaction benefit, or selling would violate your investment strategy. Never let the tax tail wag the investment dog. Only harvest losses when it fits your overall strategy. Mutual funds and tax quirks. Mutual funds distribute capital gains to shareholders at year-end. Even if you didn't sell any shares, if the fund manager sold appreciated securities during the year, those gains have passed through the shareholders and you receive a 1099 DIV showing capital gain distributions. You owe the tax these distributions even if you reinvested them. This is why tax managed funds and ETFs, which generate far fewer taxable distributions, can be significantly more tax efficient in taxable accounts. Always check a fund's distribution history before investing in taxable account. ETF tax advantage. ETF tax advantage exchange trade funds are structured differently from mutual funds and rarely distribute capital gains, making them far more tax efficient in taxable accounts. The in-kind creation and redemption mechanism allows ETFs to essentially purge low basis shares without triggering the taxable event. For investors building long-term wealth in taxable brokerage accounts, broad market ETFs are almost always more tax efficient than equivalent actively managed mutual funds. Crypto and digital assets. The IRS view. This section is crucial because cryptocurrency taxation continues to trip up millions of Americans. The IRS has been crystal clear since 2014. Virtual currency is property for the federal tax purpose. Every time you sell, trade, spend cryptocurrency, it is taxable event. This means selling crypto for USD, taxable, calculate gain loss from your cost basis to the sell price. Trade crypto for another crypto. Example, Bitcoin for Ethereum. Taxable. The IRS treats this as selling the first coin at its current market value and buying the second. Using crypto to buy goods or services. Taxable. The difference between your basis and the fair market value at the time of transaction is capital gain. Receiving crypto as payment for work. Taxable as ordinary income at the fair market value. When received, that value also becomes your basis. Mining crypto. Taxable as ordinary income at fair market value when received. Staking rewards. The IRS treats these as ordinary income when received. Crypto gifts, non-taxable to the giver. If under gift tax annual exclusion of $18,000, recipient takes the giver's basis. Simply holding crypto, not a taxable event. You only owe tax when you dispose of. Many crypto investors are unaware that trading one crypto for another is a taxable event. If you made hundreds of trades on a platform like Coinbase or Binance, you potentially have hundreds of taxable transactions to report. Taxamerica.co uses crypto tax software to efficiently calculate and report all transactions. Do not file without addressing every trade. Crypto reporting tools. Use crypto tax software, Coinly, CoinTracker, TaxBit, or Token Tax to import all of your transaction history from exchanges. These tools calculate your gain, losses, income, and generate the approximate tax forms. They integrate with taxamerica.co's filing process. If you use multiple exchanges or wallets, you'll need to consolidate all taxation data. The net investment income tax, NIIT. High earners face an additional 3.8% surtax on net investment income. The net investment income tax, this applies when your modified AGI exceeds $200,000 for single filers or $250,000 for married filing jointly. Investment in income includes capital gains, dividends, interest, rental income, and passive business income. It does not apply to wages, self-employment income, or distributions for investors regularly meeting these thresholds. Managing income strategically to stay below the NIIT threshold can be worth significant money. The home sale exclusion. One of the most generous provisions in income tax code is if you sell your primary residence, you can exclude up to $250,000 in capital gains from taxation, $500,000 if married, filing jointly. To qualify, you must have owned and used the tax as your primary residence for the last 2 to 5 years. You don't need to be a first-time seller. You can use this exclusion multiple times you can use this exclusion multiple times in your life, as long as you meet the 2 in 5 years test and haven't used the exclusion in the past 2 years. You bought your home in 2015 for $250,000 and sold it in 2024 for $650,000. Your gain is $400,000. As a married couple, you exclude $500,000, so your entire $400,000 gain is tax-free. You owe zero capital gain tax on $400,000 of profit. This is an extraordinary benefit. Home sale, partial exclusion, and exceptions. If you don't meet the full 2-year requirement, you may still qualify for partial exclusion. If you sold due to a change in employment, health reason, or unforeseen circumstances, calculate the fraction of the exclusion you qualify for based on how many months you've lived there versus 24 months. Also note, if you ever used part of your home as a home office and claimed depreciation, that depreciation is subject to recapture at 25% rate. Even with the home sale exclusion, keep records of all home improvements you made. They increase your basis and reduce your taxable gain. Key takeaways. Hold investment over 1 year to qualify for preferential long-term capital gains rates, 0% to 15% to 20%. Know your cost basis. Use specific identification for maximum flexibility. Inherited assets receive a step up in basis, a powerful estate planning tool. Tax loss harvest strategically, but watch the 30-day wash sale window. ETFs are more tax efficient than actively managed mutual funds in taxable accounts. Every crypto trade is a taxable event. Track every transaction meticulously. Home sale exclusion. $250,000 single, $500,000 married. One of the tax code's greatest gifts. 1031, exchange for real estate. Defer gains indefinitely by rolling into the like-kind property. Investment taxes rewards those who plan ahead. One decision, when to sell, how to identify shares, where to harvest a loss, can mean thousands of dollars. At taxamerica.co, we work with investors, crypto holders, and real estate owners to build tax-efficient strategies year-round, not just filing time. Visit taxamerica.co to book your free investment tax consultation. Subscribe, like, share this with a fellow investor, and I will see you in the next one.